Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his usually Monday guest on a Thursday because it is that important to talk to you about what is going on today. Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you. And again, thoughts and prayers with the Ukrainian people, with the Russians that did not want any part of this. We're with you and we're thinking about you.
Absolutely. Well said. Hey, what I wanted to talk about today is kind of two things in this final interview. One is opportunity in the chaos. All right, there are opportunities sometimes in the chaos where people sell first, and then others are out there looking to go shopping. There's a lot of stuff down early in the morning. It's already coming back a little bit. People are clearly selling off crypto in a big way. As you were looking at this morning, did you get your shopping list ready? Are you waiting a few days to see where this thing goes, or what are you thinking about opportunity in this chaos?
Yeah, so I'm waiting for the dust to settle a little bit, to see where things go, whether there's going to be escalation, how quickly this crisis is resolved before I make any big moves. But, I took my chips off the table before all this happened. So I've been in cash for a while, just kind of getting in and out, nothing long-term. Just, I've been playing with some stuff really on day trading type things, 10% here, 20% there, stuff like that. Right. But nothing longer term, and just being very careful and really managing risk, which again, when I say risk, a lot of people don't understand what that means. Risk is preservation of capital, right? Rule number one, do not lose money. You work hard for what you've earned. Any fool can make $1 million, it takes a genius to keep it. So you have to manage risk, which means the downside, understanding where the downside is, what that can cost you, and how long it can take you to get back. Versus what a lot of new investors, retail investors, all they look at is the upside, because that's all they've known. In the last 10 years, it's been nothing but upside. So people that weren't around prior to that don't understand what the downside can look like. And I saw the dot-com bubble, you saw it. I saw, the great financial crisis, you went through that. March of 2020 was nothing. That was a hiccup.
Yeah. That was talking about the ultimate V-shaped recovery, right? You shut down the economy, the Fed bails everybody out, you're off to the races. It kind of showed by the dip worked, and that's not always the right answer. So pretty crazy. The other thing, again, I'm thinking about, I don't know if you see this a lot, but a lot of people are out there doing syndications right now. And there's still deals going on. Am I crazy in thinking that there was a lot of commitments? Like, hey, I've committed $100,000 to this deal and hasn't closed yet. But I suspect that there's a lot of people pulling commitments today, because again, it's preservation of capital. When people get scared, they kind of retreat. So it wouldn't shock me if there's a lot of syndications that had commitments that saw loss of commitments today. You think that's true, or no?
It's probably going to be a mix. I would say your less sophisticated investors that have a lot less to invest are probably going to do something like that, that have limited amounts of money they can invest. Your people that are more liquid, more sophisticated, they're looking for good places to park capital. So they're not worried about it. Rates are still low. Returns are good. Generally, if you have a good operator with a good track record, you can get double-digit returns in a lot of those investments. So I think that's not going to affect the average investor moving forward, because most people understand that right now, this is not a global situation. This is a Russia-Ukraine situation, and we're going to feel the impacts economically. Sure. But from the real threat of our markets going to zero, our assets going to zero, I mean, that's just not a real threat. Right. So, people are still looking for yield. They still want to earn money. Inflation's out of control. So at the end of the day, your investable cash is being deflated by 15% just sitting around. I know they say at 7% inflation, it's real inflation at the consumer level is probably 15%, and it's going to get worse.
Absolutely. I agree with that. And then the other thing I kind of want to build on here is residential real estate. That's obviously one rental at a time. That's where we spend a lot of our time. I thought I would just run through a couple of examples and get your thoughts on. So the first one is, does this situation cause any buyers, right? Somebody who signed a contract to buy a new home, maybe they were buying an existing home, right? They're in escrow. Do you think any of those people look at the situation and get scared or nervous and cancel contracts?
No, I don't think so. The interest rates already did that last week.
Yeah,
so we
exactly.
saw record decline in applications because interest rates, like, when we've been talking about that 4% number, that gives real pause. And then you get to 5%, it's lights out.
Yeah.
And, but I don't think anybody that's, especially right now, I mean, you know, they've probably had to look at 20 houses and make offers and get rejected to get one, you know? So if somebody's in line to buy a house right now with a limited amount of inventory, they're probably moving forward and aren't going to let go of that anytime soon. But we've talked about rates before. A lot of people have told me, I think, you know, you and I disagree on the levels, but I've been saying 4% is a real threshold for people where their behavior is going to change, and it's happening. Behavior is changing. Then 5% would be lights out.
Right.
The only difference is there's so little inventory in certain areas that it's not making that big of an impact. But at large, we saw a 13-14% decline in applications. And I did a little math yesterday. So just to bring this home for people. So if you're buying, you know, if you have $2,000 a month to spend, if that's what you're qualified for, because that's how these mortgages are made. They're made on what your income is. So let's say you can, you know, you've qualified for $2,000 a month at 3%, you can buy a $474,000 house.
Wow.
Okay. At 4%, that goes down to $418,000.
Wow.
So you've dropped $60,000 with 1% interest rate on a $2,000 a month payment. At 5%, it goes down to $372,000 from 474 to 372, $100,000 drop from a 2% interest rate increase. We're going to be at 2% probably in interest rates for mortgages, probably by summer.
Yeah. You're talking about 2% raise, not 2%.
Raise. So 5%. We're going to be hitting 5% interest rates by the summer.
I agree. I agree. And I have always thought 5% the number, right? We have debated, but I think you're right. It's inventory that's making that. But yeah, 5%, because again, you still get appreciation and the double hit of interest rate, right? There may be homes at 460. There's just no homes available at 360. You may still have the capacity to buy, but if there's no inventory, it doesn't matter, right? It just doesn't matter. So
right. So what happens is people can't afford it. So houses sit, sellers realize it, and they start, you know, dropping prices, inventory starts stacking up, and the market shifts. And now that the pandemic hopefully is over and the world gets back to normal, a lot of these, you know, inventory dynamics will probably change. There's going to be a lot of builders out there. And I've said this before, if you want to buy a house, hold your horses, wait till the summer, watch interest rates. If they get up to 5%, you saw what I just said, houses will drop 20 to 25% by a 2% interest increase between now and then. So if you have these builders that are out there and they have a lot of inventory, and they can't get rid of it, they can take a haircut. They can dump stuff. That's where it starts.
That is a very good call, because a lot of people don't get that. Builders need to sell. They need to get the liquidity. It's just like China and their real estate market, right? If the developers aren't selling, their cash flow statement dries up, and it's like oxygen or blood. They just wither and die. Mom and pop existing home sellers, they have options. They could decide not to move, right? You don't think my house is worth 460, it's worth 360. I'll stay here. I like my house. The builders don't have that choice. They will take haircuts. They will take them faster. They will give deals. I think that's a very, very strong advice.
And every builder has about a 20 to 30% margin built into a new construction house. So there's your math right there. So that's where your deals are going to come from 3 months, 6 months from now, as interest rates start to get out of control from a mortgage standpoint. And, it'll take longer, like you said, to move through the retail market, because people just think, you know, their property's worth whatever it is until it isn't.
Yeah, until they have to sell. Exactly. So back to kind of the residential, because I agree with you. I don't think anybody cancels. Maybe a couple people. If you were a buyer and you were reliant on the stock, like you left your money in the stock market, like that was your down payment money, and it gets whacked in half, maybe a couple people have to back out because they're just not as liquid. But I think in general, if you got a house, you're in, because what I've seen in times like this is buyers, consumers, they want to almost nest. So they retreat to stuff that they own, and the home is that place, a la the pandemic, for example.
Yeah. When people's savings and their wealth changes, and if people start losing value in their houses and those things, that'll change behavior. But yeah, if somebody's planning on using their stock portfolio to exit and liquidate and get into real estate, well, you know, that time was what, December.
Yeah, you're a little bit late.
When you and I were talking about it, when I said the great deleveraging is beginning, now's the time to sell. And you know, I'm at Thanksgiving telling all my family that wants to buy crypto, look, this ain't the time to buy. You need to be getting out.
Yeah.
Yeah, unless you're trading, then you can trade the swings. But if you're a long-term holder, take your chips off the table at the top, buy back in at the bottom. But the thing is with the markets, all things considered, and with the Fed doing what they're doing, and the thing that hasn't been priced in is the real effects of inflation on the consumer. That hasn't been priced in, and the effects on the economy. We don't know what that is yet. You can't really forecast it. So markets are only down still. Even today, they bounced back a little bit. They're still only down about 10. NASDAQ's the worst. I don't know what it is today, 12% maybe.
Yeah, 12, 13, something like that. Yeah.
From the peak, but the other markets, the S&P and the Dow, were only down about 10%.
Yep.
And, I could look at it while we're talking just to kind of, get an idea. But I don't anticipate at the end of the day, with the Fed coming out, raising rates, with everything that's going on geopolitically, right now with conflict everywhere, I don't anticipate markets being down more than 25% as a result of everything from the peak. So if you look at where we're at now, the Dow right now, as of today, the low was 12.6%. It's back up a little bit. So it's down not even 12% right now.
Yeah.
NASDAQ's the big one. Well, actually, NASDAQ's bouncing a little bit too right now. But from the peak, NASDAQ currently is down 19%. Earlier, it was down by 22%.
Okay.
And S&P. So, at the end of the day, it's not as bad as it looks,
Right.
And you needed this little bit of a repricing anyways. We've been talking about it for a while. And, I've been saying it's all Fed driven. And, a lot of people would push back on that and say, oh, no, it's, markets go up and that's all they do. And I'm like, for the last 11 years, you're right. 12 years,
Yeah,
absolutely.
it doesn't always work that way. Yeah, exactly. Well, the last thing I want to talk about residential real estate, and I'll let you go, is, because again, there's a demand side, which we just talked about, but there's also the supply side. So do you think a situation like this causes any more people to list their homes? Like, I'm scared, I need to get out, I need to list my homes. Is this going to spark any more inventory?
No, not right now, because we don't have any meaningful declines in, most of the assets out there right now. If people's portfolios started really going down, then you'll see people say, well, shoot, we need to sell the house to put some money in savings for retirement before the housing market change. So, if you had a real serious economic situation, that could spur some people to sell. But right now, this is just a knee-jerk reaction to conflict in Ukraine. I mean, that's what the markets are experiencing right now. We had a little bit of a deflation coming into the Fed making an actual move. Again, they still haven't done anything yet, so nothing has changed, nothing to see here. So until they actually do something, we don't really know. But most people aren't even really paying attention. They get their portfolio statements, once a month, once a quarter. And most of them are in stuff that really isn't going to be that affected. But once people get those statements, then you'll see, there might be some people going back to work. There might be some people selling assets, to bolster that retirement account. We'll just have to see how it all shakes out. But right now, I'm not worried about the stock markets. I think they are repricing to where they would have been in normal circumstances before March of 2020. And they were already up quite a bit from there with QE and everything. But I think we're going to reprice back down to those levels.
Very cool, folks. So do yourself a favor. Mr. Greg Dickerson has a playlist on this channel, and he's right. He talked about the great deleveraging months ago. And if you were paying attention, you saved a lot of money. Greg, how can people find you?
Yeah, gregdickerson.com, YouTube channel, podcast is all there. Go check it out. And YouTube channel is just Greg Dickerson.
Thanks, buddy. I appreciate it.